Money doesn't disappear. It doesn't evaporate into the economy, and it doesn't trickle down the way people are often taught to imagine. Every single dollar that moves through the system ends up somewhere specific. It always lands, it always settles, it always leaves a trace. The real question has never been whether money moves. Of course it moves. The real question is where it actually goes once it starts moving, and why it keeps ending up in the same places over and over again. That question is rarely asked honestly, because once you ask it seriously, the entire story about money, effort, and fairness begins to change. The common confusion. Most people imagine the economy as a circle. Money flows from workers to businesses, businesses pay employees, employees spend money, governments collect taxes and provide services. It feels balanced, it feels mutual, it feels almost fair. This mental picture is comforting. It suggests that as long as everyone participates, everyone benefits in roughly equal proportion. But modern economies do not work in circles, they work in funnels, and funnels move in only one direction. Once money enters the funnel, its path is shaped by structure, not intention, not morality, not effort. Structure decides the direction. Structure decides the speed. Structure decides who touches the money first and who gets what's left. Why the circle model fails? The circular model assumes symmetry. It suggests that money leaving one pocket will eventually return in another form, keeping the system balanced. But real economies are not symmetrical. Some participants have leverage, some have timing, some have pricing power, and many have none of these advantages. Once this is understood, the idea of balance quietly collapses. Money does not rotate evenly through the system. It flows downward through structures of power. It cascades, not circulates. And like everything else in a system shaped by gravity, it settles at the bottom of the funnel. The core idea. Here is the central truth that explains almost everything about how money really works. Money does not spread evenly as it moves through the economy. It concentrates. Not because of a secret conspiracy, not because of backroom coordination, not because of hidden villains quietly pulling strings behind the scenes. It concentrates because of structure. The system itself is built in a way that naturally funnels money towards specific points of control, towards assets, leverage, ownership, and pricing power. Once money reaches these points, it doesn't just pass through, it lingers, it compounds, and it returns again and again through interest, rent, fees, and margins. Do you understand where money actually ends up? You don't need better stories or comforting explanations. You don't need slogans, motivation, or financial myths. You need to trace the movement. You need to observe the pathways. You need to follow the flow. Step 1. Where money enters the system. Most people believe money enters the economy through work, through productivity, through value creation. That is only partially true. Most new money enters the economy through loans, credit expansion, government spending, and financial instruments. And critically, this money does not enter at the bottom. It enters through banks and financial institutions, large corporations, governments, and existing asset holders. That starting point matters more than most people realize, because whoever receives money first gets the first move. They get the first chance to buy assets, set prices, leverage capital, and position themselves before inflation spreads. This is not a moral judgment, it is a mechanical advantage. In systems, first access compounds. Why first access matters. Money is not neutral when it enters the system. Timing changes everything. Early money behaves very differently from late money, even if the amount is the same. Early money arrives before prices adjust. It buys assets while they are still cheap. It locks in low borrowing costs and long-term rates. It uses leverage when leverage is most powerful, and in doing so, it sets expectations that others must later react to. Late money enters after the shift has already happened. It faces higher prices across assets and living costs. It reacts instead of positioning ahead of change. It absorbs inflation rather than benefiting from it. And it negotiates wages and terms from weaker ground. This process is rarely noticed because it unfolds quietly and gradually, but over time the gap widens. Small timing advantages compound into enormous divergence. Step 2. How money actually moves. Once money enters the system, it does not spread evenly. It moves in layers. First, it flows into assets: stocks, real estate, bonds, private businesses, financial instruments. Only later does it reach wages, salaries, hourly income, benefits, cost of living adjustments. By the time money reaches wages, most of the largest gains have already been captured. This is not favoritism, it is timing. Assets react immediately, wages react slowly, and in finance, timing is everything. Why assets come first? When credit expands, asset prices respond almost instantly. This happens because assets are already embedded in financial markets. They are continuously priced, constantly traded, and easily leveraged. They sit directly in the path of new money as it enters the system. When interest rates fall, borrowing becomes cheaper. Cheaper credit increases demand for assets. As demand rises, prices move up quickly. Those who already own assets benefit immediately without changing their behavior, increasing effort, or producing anything new. Leverage magnifies this effect. Borrowed money used to buy appreciating assets creates asymmetric upside, where gains are multiplied while risks are often spread or delayed. Wages move very differently. They're negotiated once or twice a year. They are constrained by company budgets, profit margins, and long-term expectations. This built-in delay creates a lasting timing advantage for those closest to assets. And once a timing advantage exists, it compounds into sustained financial dominance. Step 3. The extraction layer. As money moves through the system, it does not simply flow, it gets siphoned through interest payments, fees, rent, taxes, corporate margins, service costs. Imagine a single dollar moving through the economy. It starts as a loan. Part of it goes to interest, part goes to rent, part goes to fees, part goes to overhead. Each slice feels small in isolation, but over time those slices accumulate, and they don't disappear, they move upward. Why this creates concentration? People often ask, if money keeps moving through the economy, why does wealth keep pooling in the same places? The answer is simple but uncomfortable. Flows compound. Those who control capital, credit, infrastructure, distribution, and pricing power do not receive money one time, they receive it repeatedly. Interest returns every month. Rent arrives every cycle. Fees, margins, and dividends show up again and again. When you sit near the top of the funnel, effort becomes less important than position. You don't need to work harder or faster. You need more volume moving through the system. Every transaction that passes through your control point leaves a small trace behind. Over time, those traces accumulate into concentration. The system is structured to route increasing volume toward these control points. And once volume flows to the top, wealth naturally pools there. The role of financial institutions. Banks and major financial entities occupy a unique position. They create access to money, price money, earn interest on it, and hold claims on future income. Money does not simply pass through them, it stays long enough to matter, not forever, but consistently. And over decades, consistency beats effort. This is why financial institutions grow even during economic stress. They are positioned upstream. The misleading idea of the middle. The middle class is often described as the engine of the economy. In reality, it is the throughput layer. Money passes through mortgages, car loans, consumer spending, taxes, insurance, and education costs. The middle absorbs volatility. The top absorbs accumulation. This is not a failure of individuals, it is structural. Why hard work alone is not enough. Hard work determines income, but accumulation is determined by position. Where you stand relative to assets, leverage, cash flow, and ownership matters more than how hard you push. This is why productivity can rise while financial stress increases. The gains are flowing, just not evenly. Where money ultimately ends up. Over time, money concentrates in asset owners, shareholders, lenders, and institutions with pricing power, not because they are evil, but because the system routes money toward control points. In a system built on leverage, control beats contribution. Why this is rarely explained. This reality is uncomfortable. It challenges merit-only stories, effort-based explanations, and simple financial advice. So instead, people are taught tactics: budget harder, save more, work longer, without ever seeing the terrain. The real takeaway: this is not about resentment. It is about orientation. If you don't understand where money flows, you will always feel like you are swimming upstream. Seeing the structure does not make you cynical, it makes you strategic. That is where the money actually ends up. Decoded.